How do futures curves affect options on natural gas? Have you ever wondered how the prices of natural gas futures can impact the options you trade? Understanding the relationship between futures curves and options is essential for any trader. Futures curves representing the prices of natural gas futures contracts over different delivery months. They show how the market expects prices to change over time. These curves can take two main shapes: contango and backwardation. In a contango situation, longer-dated futures prices are higher than near-term prices. This indicates that the market expects prices to rise in the future. On the other hand, backwardation occurs when near-term prices are higher than longer-dated prices, often signaling tight supply or increased immediate demand. The shape of the futures curve plays a significant role in determining the pricing and strategies for options on natural gas futures. Options derive their value from the underlying futures contracts. Since futures prices vary by delivery month, the futures curve shapes the expected price distribution that options pricing models use. When the futures curve is in contango, it suggests that the market anticipates higher prices ahead. This can increase the value of call options on longer-dated contracts. It can also affect implied volatility levels, which are crucial for pricing options. Conversely, in a backwardation scenario, the higher near-term prices can lead to increased value and volatility for options on front-month futures. Let's break it down further. The term structure of futures prices influences implied volatility, a key component of option premiums. Seasonal demand patterns, like increased heating needs in winter, can cause the futures curve to steepen or invert. For example, winter contracts may trade at a premium due to expected higher consumption, leading to higher option premiums on those contracts. Another aspect is calendar spread options. These options are based on the price difference between two futures months rather than a single contract. The shape of the futures curve is critical here. Calendar spread options gain or lose value based on changes in the futures price differential. Traders often use these options to hedge or speculate on changes in the futures curve caused by seasonal demand shifts or supply changes. The futures curve also guides hedging strategies. Options traders can decide which contracts to target based on the curve. If the curve shows contango, a trader might use call spreads between near and for months to hedge against rising prices while limiting premium costs. In a backwardation situation, options on near-term futures may be more valuable due to higher immediate price risk. As futures contracts approach expiration, their prices converge toward the spot price. This convergence affects the intrinsic value of options on those contracts. The shape of the futures curve can indicate how prices are expected to move as expiration nears, influencing option exercise and assignment decisions. In practical terms, understanding the natural gas futures curve allows options traders to select appropriate strike prices and expirations based on expected price trends. They can use calendar spread options to capitalize on or hedge against changes in the curve shape. Additionally, traders can manage risk by aligning option positions with seasonal demand patterns reflected in the curve. Overall, the futures curve is a fundamental factor in natural gas options trading. It reflects market expectations of price changes over time, which directly impact option valuation, risk management, and strategic decision-making. By grasping these concepts, traders can make more informed choices in their options trading strategies.